Welcome, deep divers. So imagine a company, right? Its stock price today is just teetering on this balance point. On one side, you've got this immense promise of future explosive growth, and on the other, well, the very real weight of present-day risks.
Exactly. It's a real high-stakes, high-reward scenario. And today we're doing a deep dive into IREN Limited. They trade on NASDAQ, ticker IREN.
And it's a fascinating story because this company is transforming pretty rapidly, moving from being mainly a cryptocurrency miner to something much broader, diversified digital infrastructure provider.
That's the key transformation. And the core question we're looking at today, the real driver of this analysis is, can IREN actually ride these two massive waves, institutional Bitcoin adoption and huge AI growth successfully?
Or, will its ambitions, which are really capital intensive, just stretch it too thin? Could that lead to financial problems, maybe dilute shareholder value?
That's the crux of it. Our goal here is really to give you a shortcut, a way to understand what truly matters about IREN. This analysis is built on some solid research, specifically the IREN Deep Stock Research by Dr. Evelyn Reed, PhD, CFA.
Right, and that research is current as of July 16, 2025, when the stock closed at $16.68. So let's unpack these insights together.
Let's do it.
Okay, let's start with Chapter 1, Business Analysis. So fundamentally, what does IREN actually do? The research talks about this interesting dual engine model. What are these engines?
Right, the dual engine model. So the first engine, which is really their foundation, is Bitcoin mining. They started this back in 2019.
Okay.
They use specialized ASIC computers, application-specific integrated circuits, basically custom chips just for mining Bitcoin efficiently. They use these to secure the network and, earn block rewards and transaction fees.
Standard mining operation, sounds like.
Pretty much, but here's the really crucial part, their financial strategy. They immediately sell all the Bitcoin they mine every single day.
Oh, interesting. So they don't hold it.
No holding, no speculating on price. It's a deliberate choice to fund operations and growth, and it keeps them, deliberately out of the crazy volatility of crypto prices. They treat it like manufacturing something, not holding a speculative asset.
That makes a lot of sense. It definitely de-risks one big element of the crypto world. Okay, so that's engine one. What's the second engine, the high growth one?
That would be their AI cloud services. They launched this just last year in 2024. Here, they're deploying really high-end NVIDIA GPUs. We're talking H100s, H200s, and they've even just acquired the new Blackwell B200 and B300 models.
Wow, the latest stuff.
Absolutely. And they supply this raw compute power, basically on a white label basis, to other big US AI cloud providers.
So other AI companies are essentially renting IREN's horsepower and putting their own brand on it.
Exactly. It extends the reach of those providers without them having to build out all the infrastructure themselves. It's a smart way for IREN to tap into that huge AI demand.
That's a pretty significant strategic shift, moving right into the heart of the AI boom.
Yeah.
And the research mentioned a third stream emerging, too. Something about bigger infrastructure.
Precisely. They're also starting to build out dedicated AI data centers for future colocation services.
Colocation?
Yeah.
Meaning renting out space and power.
Yeah, renting out the space, the power, the cooling, the connectivity within their specialized data centers for other companies to put their hardware in. They're building these large-scale, liquid-cooled facilities like the Horizon 1 project down in Childress, Texas. These are designed specifically for next-gen AI hardware for third parties.
So not just providing the compute, but the actual physical home for it, too. That sounds like a potentially huge future revenue stream. Almost like becoming a digital utility.
That's a good way to think about it. It positions them as a foundational player.
Okay, speaking of scale, how big did IREN actually get in its original mining business? And what's their overall physical footprint like now?
They scaled incredibly fast. They're now one of the largest publicly listed Bitcoin miners out there. They just hit their target of 50 exahashes per second. That's EHS of self-mining capacity.
50 exahashes. How big is that in context?
It's massive. Think of it like having the processing power equivalent to maybe 6% of the entire global Bitcoin network. It's a huge amount of compute.
Wow. Okay. And where's all this happening?
They've got 4 operational data center sites. 3 are up in British Columbia, Canada, and 1 is that Childress site in Texas.
And they're still expanding, right? I think the research mentioned projects like Sweetwater in Texas.
Yep. They have a vast development pipeline. Sweetwater is a big one, securing over 2 gigawatts GW of power capacity for future expansion. It's an enormous amount of power, enough for a small city, easily.
Incredible. So with all this infrastructure for both mining and AI, what's their core value proposition? What are they selling fundamentally?
At its heart, it's about providing low-cost, high performance, and really power-dense computing infrastructure. And the unique angle is that it's all powered by 100% renewable energy.
Ah, the renewable angle.
Yeah.
Big selling point.
It really is. That focus on efficiency and sustainability is a major draw, not just for crypto-native clients, but increasingly for enterprise and AI clients who have those ESG mandates, environmental, social, and governance requirements. It's a powerful combo.
Okay, let's zoom out a bit then. IREN is sitting right at this intersection of crypto and AI, two incredibly hot and incredibly power-hungry sectors. What are the big market trends we need to understand here?
Well, it's a fascinating confluence. In Bitcoin mining, you're seeing this trend towards institutionalization in 2025. Post-halving, it's all about efficiency. Plus, you've got this digital gold rush fueled by high Bitcoin prices and those new spot ETFs making it easier for traditional investors to get involved.
Right, the ETFs open the floodgates a bit.
Yeah, they really did. But the critical trend, especially for a company like IREN, is how many miners are pivoting, or at least diversifying, into AI and high-performance computing, or HPC.
Why the pivot?
Because they already have the core competency, building and managing these incredibly power-dense data centers. And here's the kicker. AI data centers are projected to actually surpass the entire Bitcoin network in energy consumption pretty soon.
Wow, really? More than Bitcoin?
That's the projection, which means you're going to see intense, absolutely fierce competition for power, and the AI infrastructure market is already severely supply constrained. There just isn't enough specialized compute power and data center space to meet demand.
So IREN's bet on infrastructure seems well-timed. But who are they competing against? It must be a tough landscape.
Oh, it's incredibly competitive. You've got major public rivals like Marathon Digital, that's MARA, Riot Platforms, RIOT, and CleanSpark, CLSK, just to name a few.
And what defines success in that competition?
It really boils down to a few key things. Securing large amounts of low-cost power, ideally long-term contracts. Deploying the most energy-efficient hardware, that's where the JTH metric, joules per terahash, comes in. Lower is better, like fuel efficiency for miners.
Right, getting more hash for less power.
Exactly. And finally, disciplined capital management. It's easy to overspend in this space. IREN actually has a competitive edge here with its leading fleet efficiency, around 15 JTH currently.
And how does that translate financially?
That efficiency helps them achieve an estimated all-in cash cost of around $41,000 per Bitcoin. In a volatile market, having lower production costs is a significant advantage.
Makes sense. What about the regulatory side? Crypto regulation is always shifting. Any good news or looming threats there?
It's definitely a complex picture. On the plus side, there was that SEC staff clarification back in March 2025, saying proof-of-work Bitcoin mining isn't automatically a security. That removed a pretty big cloud of uncertainty.
Okay, that's helpful.
But the persistent risk is global government scrutiny over the sheer amount of energy these operations consume. We've already seen moratoriums, punitive taxes, even outright bans in some places around the world. That kind of regulatory risk, especially tied to energy use, is always lurking.
A constant geopolitical factor to watch. So, with all these challenges, capital, power, regulation, what are the barriers to entry for someone wanting to start a similar business today?
They are exceptionally high, and frankly, they're getting higher. First, you need massive amounts of capital just for the data centers and the incredibly expensive hardware, whether it's ASICs or high-end GPUs.
Okay, money's number one.
Number two, and maybe even more critical, is securing large-scale, reliable, low-cost power. We're talking multi-year power purchase agreements, or PPAs. That takes expertise, relationships, and a lot of time. It's not something you just find overnight.
Right, you can't just plug these things into the wall.
Not even close. And third, you need really sophisticated technical and operational expertise to run these data centers 24/7. It's a complex, demanding operation.
So it's definitely not a business you could just jump into easily. This leads us nicely to what the research calls IREN's durable competitive advantage, the power broker moat. What exactly does that mean?
This is probably the most important strategic point. While their efficient hardware is great, IREN's real long-term advantage, their moat, is their strategic control over these vast low-cost power resources. Remember that 2,900 megawatts of capacity.
Yeah, the huge number.
In a world where both Bitcoin mining and AI are desperate for more energy, IREN isn't just a consumer of power. They're positioned as a kind of power broker.
A power broker. So they control the crucial resource, cheap, renewable power, and can decide where to direct it for the best returns, mining or AI.
That's exactly the idea. They own the bottleneck asset. And we see this strategy in action with their recent decision to pause mining expansion at 50 ELHs.
Right, you mentioned that.
They're deliberately choosing to redirect that capital expenditure towards building out their AI data center projects, like Horizon 1 and Sweetwater, because they see a better return there right now. They can flexibly allocate their core asset, that power capacity, to whichever application promises the highest profit.
So the investment case becomes less about the day-to-day price of Bitcoin and more about the fundamental and likely increasing value of their energy and infrastructure assets.
Precisely. It reframes the whole story. It's about owning the digital real estate and the power lines in this new digital economy. That's a potentially very durable competitive advantage.
Very interesting perspective. Okay, let's shift gears. Let's move to Chapter 2, Management Evaluation. Who is actually steering this ship? Who's making these big strategic calls?
The leadership team is quite impressive, actually. It's headed by the co-founders and co-CEOs, Daniel and Will Roberts, their brothers. And their backgrounds are really relevant. They have extensive experience in finance, yes, but also in large-scale infrastructure development and renewable energy. The research notes they have a track record of delivering over $25 billion in global infrastructure projects.
$25 billion. That's serious infrastructure experience. That seems crucial for a company building massive data centers.
Absolutely vital. And their CFO, Belinda Nucifora, brings over 25 years of finance experience to the table as well. So there's real depth in finance and large-scale project execution.
What about their track record at IREN, specifically, especially navigating challenges like the crypto winter a few years back?
Their execution at IREN has been pretty strong. They had that 50 EHs mining target in under 3 years, often meeting or even beating their stated goals. And yeah, the 2022 crypto winter was a major test.
How'd they handle it?
Quite proactively, according to the research. They terminated some unfavorable hosting deals they had. They monetized prepayments they'd made to boost liquidity. And crucially, they stuck to their focus on low-cost self-mining. And remember that policy of selling Bitcoin daily.
Yeah, the de-risking strategy.
Well, during that crypto winter year, it resulted in them achieving a 75% higher average realized price for their Bitcoin compared to if they'd just held it. That really showcases effective risk management in a brutal market.
It does sound like smart discipline management. How are they on communication and transparency with the market?
They seem quite transparent. They put out detailed monthly operational updates, which is pretty granular, plus regular press releases for major news, and their earnings call transcripts are publicly available.
Okay.
They're also in the process of transitioning to U.S. GAAP accounting standards, which should enhance financial transparency even further. And insider transactions, like recent equity grants, RSUs, restricted stock units are properly filed.
So those RSUs help align management incentives with shareholders.
That's the idea. Giving them stock that vests over time means they benefit when the company does well long term.
Makes sense. Let's talk about capital allocation. Fueling the dual engine growth. Where has their money been going? And what's the biggest decision they've made lately with their capital?
Their strategy has been all about aggressive organic growth funded internally. They haven't really done acquisitions. Almost all the capital has flowed into two things: data center construction and hardware, both ASICs for mining and those expensive NVIDIA GPUs for AI.
And the single most significant recent decision?
Without a doubt, it's the decision to pause the Bitcoin mining expansion at 50 EHs and pivot that future capital expenditure towards the AI infrastructure business.
Right, the shift we discussed.
Management explicitly sees AI as offering a superior risk-adjusted return right now. This isn't just tinkering, it's a fundamental strategic shift. It will really define IREN's future, and it's the ultimate test of whether their capital allocation skills are truly sharp.
A huge bet on AI infrastructure. Given this focus on growth and heavy investment, have they ever done share buybacks or paid dividends?
No, absolutely not. As a high-growth company pouring every available dollar back into expansion, there's no history of buybacks or dividends. They've been clear that they're deferring any distributions to shareholders to accelerate growth, especially building out those AI data centers.
And just to be clear, this IREN Limited is different from the Italian utility.
Yes, good point to reiterate. IREN Limited, ticker IREN on NASDAQ, is completely separate from the Italian utility IREN SpA, which does pay a dividend. Easy to get confused, but totally different companies.
Got it. Okay, the big financial metric. Return on invested capital, ROIC. With all this spending, how does their ROIC look?
Well, here's where the current financial picture gets stark. Their trailing 12-month ROIC is actually negative, at negative 2.12%.
Negative 2%.
Yeah, and that's measured against a very, very high weighted average cost of capital, or WACC, which the research estimates at 26.65%.
Whoa, a WACC over 26%. That's extremely high.
Mm.
So a negative ROIC against a hurdle rate that high, that means they're currently destroying value, right?
Yeah.
Every dollar invested isn't just not meeting that 26% expected return, it's actually losing money on an operating basis right now.
That's exactly what it indicates: current value destruction. Now, this isn't entirely unusual for companies in a pre-profitability heavy investment phase, especially in a risky sector, but it highlights the challenge.
So the entire bull case, the whole investment thesis, hinges on the belief that future ROIC will not just turn positive, but dramatically exceed that incredibly high cost of capital to justify the current spending and risk.
Precisely. It's a bet on massive future value creation, significantly outweighing today's burn rate and that high WACC. It's all about the future payoff.
Okay, let's dive deeper into those numbers. Chapter 3, Financial Analysis. Let's get the key metrics on the table as of mid-July 2025. Market cap first.
Right. Market cap is hovering around $4.0 billion to $4.4 billion.
And revenue growth trends. You mentioned explosive growth earlier.
Yeah, looking back 5 years, it's really stark. They started from a tiny base, like $2.17 million in revenue back in June 2020. By June 2024, that was up to $188.76 million. And their trailing 12-month revenue showed 128% year-over-year increase. It's genuinely hyper-growth territory.
Incredible top-line growth. But what about profit margins? Is any of that revenue dropping to the bottom line yet?
This is where you see that real split we talked about. As of March 31st, 2025, their gross profit margin was exceptionally high, 91.53%.
91%, that's huge.
It really is. And it strongly validates the core economics, taking cheap renewable power and turning it into valuable output, whether Bitcoin or AI compute. The basic model works beautifully at the gross level, but that impressive gross profit gets eaten up by high operating expenses. Think SG&A, R&D for the new ventures, data center operating costs beyond just power. So the operating profit margin was actually negative 6.36%, and the net profit margin was negative 9.59%.
So still solidly loss-making on a GAAP basis.
Correct. Not yet profitable overall.
Okay, and free cash flow generation. Given the losses in heavy investment, are they burning cash?
Oh, yeah. Consistently and deeply negative free cash flow. They did generate some positive cash from operations, about $52.7 million in fiscal year 2024, but that was completely swamped by the immense capital expenditures, the CapEx, on building data centers and buying all that hardware.
So cash is flowing out the door to build for the future.
Exactly. Typical for a company in this aggressive growth phase, prioritizing scale first.
What about overall financial stability? How solid do they look right now?
Well, consistency isn't there yet. As a young company in a volatile industry, they've reported net losses for the last 4 fiscal years. No history of stable earnings.
Okay, that's...
Their debt-to-equity ratio as of March 31st, 2025 was around 0.23. That's generally considered manageable, though it has ticked up recently because they issued some convertible notes to fund expansion.
Convertible notes. Debt that can turn into stock later.
Right. But the current ratio is something to watch. It was 0.46.
Below 1.0.
Yeah.
That's usually a warning sign for liquidity.
It can be. A current ratio below 1.0 means current liabilities exceed current assets. In IREN's case, it likely reflects large short-term payables for hardware orders and construction costs. It suggests potential near-term liquidity pressure if cash inflows don't keep pace.
So managing cash flow carefully is critical. And dividends, again, not applicable.
Correct. No dividends. All focus is on reinvesting for growth.
This whole financial picture really seems to crystallize around what the report calls the profitability inflection point gamble. This sounds like the absolute heart of the matter.
It really is. IREN's entire financial structure, its very existence in its current form, is a high-stakes bet on reaching that point where revenues scale enough to cover all costs and start generating positive net income and, crucially, positive free cash flow.
And the justification for the gamble is that huge gross margin.
Exactly. That 90% plus gross margin proves the fundamental business model converting cheap power to valuable compute is sound. The problem is just scale. They haven't yet reached the scale needed for operating leverage to kick in and cover all the corporate overhead, depreciation from the massive investments, and interest costs.
So the critical question for anyone investing is, what's the probability and what's the timing of them hitting that inflection point?
That's the million-dollar, or rather, billion-dollar question. Investing in iron today is fundamentally a bet that they will reach that future state of profitability and positive cash flow, and that it will happen soon enough to justify the current valuation and risk. It's a bet on future execution and market conditions aligning.
Given all this, how do you even put a value on a company like IREN? Let's talk valuation analysis.
It's definitely challenging. Traditional metrics based on earnings, like the price to earnings PE ratio, are basically useless right now because earnings are negative.
Right. And
Exactly. Now, some analysts are projecting a forward PE, looking ahead, maybe around 16.5, but that's highly speculative. It depends entirely on them hitting those future profit targets.
okay, what about looking at sales? Price to sales.
On a price to sales PS basis, IREN looks expensive. Its PS ratio is around 9.5. Compare that to the broader S&P 500, which has a PS closer to 3.1.
So a significant premium based on sales.
Yes, but the argument is that the premium might be justified by its hyper growth rate and the sheer size of the market opportunity they're chasing in AI and digital infrastructure. You pay up for that kind of growth potential.
Makes sense. What about trying to estimate intrinsic value using a discounted cash flow, DCF model?
A DCF model tries to estimate value based on projecting future free cash flows and discounting them back to the present. It's theoretically sound, but its major weakness, especially for a company like IREN, is that it's extremely sensitive to the assumptions you plug in. Future growth rates, margins, the discount rates, small changes in assumptions can lead to wildly different valuation outcomes. It's particularly tricky for high-growth, pre-profitability companies where the future is so uncertain.
So handle with care.
Yeah.
But did the research attempt an educational DCF? What kind of value range did it suggest?
It did, acknowledging those limitations. The educational DCF model, which tried to incorporate potential cash flows from both Bitcoin mining and the growing AI cloud services, yielded an estimated intrinsic value range for IREN of $11.50 to $21 per share.
$11.50 to $21. That's a very wide range.
It absolutely is. And that wide range itself really underscores the high level of uncertainty and the speculative nature of valuing IREN right now. There's just so many variables in play.
What were some of the key assumptions driving that DCF range?
Well, the model used a 10-year forecast period. It assumed revenue growth would gradually taper off from the current hypergrowth rates over those 10 years. It used a terminal growth rate, the assumed growth rate, into perpetuity after year 10 of between 2.0% and 3.0%.
Okay, standard enough. What about the discount rate? You mentioned the WACC was very high earlier.
Exactly. Reflecting the high risk, the base case used a high discount rate, or WACC, of 25.0%. That high rate significantly lowers the present value of those future cash flows, accounting for the company's systematic risk, the volatility of the crypto and AI industries, and its current lack of profitability.
Right. That 25% WACC really puts a damper on the present value of distant future profits. Okay, we've covered the business, the management, the financials. Now let's move into part 2 and look at market perception. Chapter 4, market sentiment. How is the market actually viewing IREN? Let's start with the professional analyst community.
The professional analysts who cover IREN are overwhelmingly bullish. The consensus rating is actually a strong buy.
Strong buy. Okay,
Yeah.
price targets.
The average 12-month price target sits somewhere between $19.71 and $22. But again, there's a wide range, even among analysts, from a low of $12 to a high of $26.
So even the bulls disagree on how bullish to be. Any recent analyst actions?
Yes, there's been recent positive movement. Firms like B. Riley Securities and Macquarie actually raised their price targets just in July 2025. And the general media coverage tends to be positive too, highlighting their milestones like hitting 50 EHs, the big NVIDIA GPU purchases, and setting new monthly revenue records.
Okay, so analysts in the media seem pretty positive. But how does that square with what traders are doing? Looking at market indicators, like short interest.
Here's where you see a really interesting stark contrast. The trader view seems much more contentious. IREN has a very high short interest, somewhere between 13.5% and 15.5% of the publicly traded shares, the float.
15% short, that's significant.
It really is. It clearly marks IREN as a battleground stock. A large chunk of the market is actively betting against the company that the price will go down.
But isn't the stock price actually going up? What about moving averages?
That's the other side of the trader coin. Despite the high short interest, the stock has been in a powerful uptrend. It's trading well above both its 50-day and 200-day moving averages. That kind of momentum is very attractive to trend following and momentum investors.
So, a real split personality in the market. Analysts are bullish, short sellers are heavily bearish, and momentum traders are riding the uptrend. This leads perfectly into what the research calls the growth versus gravity standoff. How do we make sense of these conflicting signals?
It really boils down to a fundamental conflict, a tug of war between that powerful growth narrative and the gravity of the current financial performance.
Growth versus gravity. Explain that a bit more.
The bulls, including many analysts, are focused squarely on the future, the exponential growth potential, the massive market opportunities in AI and digital infrastructure, the power broker moat. They're looking forward.
Okay, the blue sky scenario.
Right. The bears, on the other hand, including those short sellers, are anchored in the present-day financial reality. The negative earnings, the negative free cash flow, the immense and ongoing need for capital, which could lead to more dilution. They're looking at the current numbers and the immediate risks.
So it's a clash between future potential and present financial weakness.
Exactly. And that tension, that standoff between the exciting growth story and the gravitational pull of the current financials is precisely why the stock is so volatile and why you see such divergent opinions in the market.
A classic battleground. Okay, let's peel back another layer. Chapter 5, ownership structure. Who actually owns IREN shares? Does that give us any clues?
The ownership structure is quite revealing, actually. It's highly concentrated among institutional investors and company insiders.
Okay, how much do institutions own?
Collectively, institutional investors own about 53.6% of the outstanding shares, so over half the company.
And who are these institutions? Any notable names or types of firms?
It's an interesting mix. You've got some specialized technology and cryptocurrency-focused funds, as you might expect. But significantly, you also have highly sophisticated quantitative trading firms and major investment banks involved.
Like who?
Names that pop up in the research include Group 1 Trading, BNP Paribas, Susquehanna International Group, SIG, Citadel Advisors, and Morgan Stanley. These aren't typically long-term fundamental investors. Many are quant funds or arbitrage desks.
Quant funds and arb desks. That's interesting. What does their recent activity show?
There was a pattern of really aggressive accumulation, particularly in the first quarter of 2025. Citadel, for instance, increased its position by over 400%, while Trading boosted its stake by over 1,000%.
Wow, huge increases. What does that suggest?
It suggests that these sophisticated players, often called smart money, see a compelling, likely quantifiable reason to own the stock. It might be related to a sum of the parts valuation, valuing the power assets separately, perhaps, or maybe they strongly buy into that power broker thesis we discussed.
So their heavy buying provides a strong counterargument to the high short interest.
It absolutely does. It's a powerful endorsement, suggesting that, despite the risks, there's a data-driven bull case being made by some very shrewd market participants.
What about insiders? Are the founders and management heavily invested?
Yes. Insider ownership is substantial, around 13%. That's generally seen as ensuring strong alignment between management and shareholders. The co-CEOs, Daniel and William Roberts, each own over 6% personally. That's significant skin in the game.
And recent insider transactions? Any big selling?
The recent transactions noted are primarily related to equity-based compensation, like that large RSU grant to Daniel Roberts we mentioned earlier. There's no evidence of significant open market selling by insiders, which is usually a positive sign.
Okay, so strong institutional backing, significant insider ownership. Is the ownership concentrated overall?
Relatively so, yes. The top 25 shareholders control over 54% of the company. This suggests a core group of deeply invested, likely knowledgeable stakeholders who have significant influence over the company's direction.
So you could frame this ownership structure as a kind of smart money endorsement, countering the bearish sentiment seen in the short interest.
I think that's a fair interpretation based on the research. The presence and recent buying activity of these sophisticated institutional players lends significant credibility to the bull case.
Okay, let's move to the final assessment chapter before the conclusion. Chapter 6, risk assessment. Let's use a SWOT analysis. Strengths, weaknesses, opportunities, threats to structure this. What are IREN's core strengths?
Key strengths are definitely that foundation of low-cost renewable energy, their best-in-class hardware efficiency, that 1516 JTeach number, their proven ability to execute on large-scale infrastructure projects, and that strategic diversification into the high-growth AI sector.
Got it. Now, the flip side, what are the internal weaknesses?
The big ones are the current negative profitability and negative cash flow that creates ongoing financial pressure. The intense capital requirements for growth, which carries the risk of further dilution for existing shareholders, and the fact that the AI business, while promising, is still nascent in terms of execution. The research notes a lack of publicly announced long-term contracts for those major AI data center projects, like Horizon 1, that represents an execution uncertainty.
Okay, weakness is clear. What about the external opportunities IREN could seize?
The opportunities are massive. First and foremost, the absolutely explosive demand for AI compute power. It's a generational shift. Second, the potential for Bitcoin price appreciation, which would obviously benefit the mining side of the house. And third, that longer-term potential to really evolve into a digital utility, leveraging those power assets across different high-value compute needs.
Huge potential upside. Finally, the external threats. What are the biggest dangers lurking out there?
Key threats include the inherent volatility of the Bitcoin market, which still impacts sentiment even if they sell daily. Regulatory scrutiny, especially around energy consumption, remains a constant overhang. Intense competition from other well-funded miners and data center providers fighting for the same power deals and customers.
Those are significant. How do broader macroeconomic factors play into this, like interest rates and inflation?
They definitely have an impact. As a very capital-intensive business constantly needing funding for growth, higher interest rates are a direct negative. They increase the cost of borrowing and raise that already high WACC, making expansion more expensive.
Okay, higher rates hurt. Inflation.
Inflation is more of a double-edged sword. On one hand, it can increase their operating costs, power contracts might have escalators, hardware costs could rise. But on the other hand, high inflation often strengthens the narrative for Bitcoin as digital gold, a potential inflation hedge, which could drive the Bitcoin price higher, benefiting their mining revenue.
Interesting dynamic there. Now, let's focus on a major specific threat the research highlights. The geopolitical squeeze play. U.S.-imposed tariffs of 2025. It sounds really serious.
It is. This is flagged as a major and material threat. The U.S. government has imposed significant tariffs, 30% or potentially even higher, on goods manufactured in China, and that specifically includes the ASIC miners that are crucial for Bitcoin mining.
30% or more. Ouch. What's the direct financial impact?
It directly increases the capital expenditure needed to buy mining hardware. We're talking potentially tens of millions of dollars in additional costs for IREN just due to tariffs money that doesn't buy any additional hashing power, just covers the tax. It directly squeezes the return on investment for mining expansion.
A direct hit to ROI. What about the strategic impact? Supply chains.
That's perhaps even more concerning long-term. The threat of further tariff escalations, there's been talk of potentially up to 60%, creates profound uncertainty around their supply chain for critical hardware.
So it forces tough choices.
Exactly. This squeeze play, as the research calls it, forces difficult decisions for U.S.-based miners like IREN. Do they just absorb the higher costs, reducing profitability? Do they try to find less efficient hardware from non-tariffed countries, if it even exists at scale? Or do they wait and hope that the major Chinese manufacturers like Bitmain successfully relocate their supply chains outside of China? That relocation is happening, but it's a slow, nascent, and risky process.
So this tariff situation is a major headache, a top-tier concern that directly threatens their cost structure and scaling plans.
Absolutely. It's a significant geopolitical headwind that complicates their operational efficiency and future investment decisions.
Okay, a lot to unpack, though, on the risk front. Let's bring everything together now. Chapter 7. Conclusion. Can you synthesize our findings? What's the ultimate bull case for IREN?
The bull case really stands on several strong pillars. First, that digital power broker, moat the control over low-cost, renewable power, giving them flexibility between Bitcoin and AI. Second, visionary management with a proven track record in building massive infrastructure projects, plus significant insider ownership aligning their interests. Third, best-in-class operational efficiency in their mining fleet, leading to those high gross profit margins. And fourth, that smart money endorsement from sophisticated institutional investors who have been aggressively buying this stock.
A compelling set of arguments. Now, what's the counter-narrative? Summarize the core bear case risks.
The bear case focuses on the grounded realities and risks. First, the profitability mirage. The company is still burning cash and unprofitable, relying on an inflection point that might be delayed or never fully materialize. Second, there's high-stakes execution risk involved in fighting a complex war on two fronts, Bitcoin and AI, with the potential for costly missteps in capital allocation. Third, the company is highly susceptible to external headwinds, crypto market downturns, unfavorable regulations, and especially that escalating U.S.-China trade war with the tariffs. And finally, the ongoing need for capital raises the specter of continued dilutive funding for shareholders.
So where does that leave us on valuation? Let's revisit the valuation summary.
Right, that educational discounted cash flow DCF model, trying to capture both the Bitcoin mining and the emerging AI cloud services revenue streams, produced that wide estimated intrinsic value range of $11.50 to $21 per share. The width of that range really speaks volumes about the level of uncertainty here.
And the concluding outlook. Based on the stock price of $16.68 on July 16, 2025, how does it stack up against that value range in the overall picture?
Well, at $16.68, the share price falls squarely within that estimated intrinsic value range. It doesn't scream obvious bargain, but it also doesn't look excessively overvalued based on that DCF analysis, given the inherent uncertainties.
So the market price seems to be reflecting this balance of risk and reward.
That appears to be the case. The current market price seems to be fairly balancing the immense growth potential embedded in IREN's dual-engine strategy against the very substantial execution risks, market risks, and those geopolitical risks like the tariffs. Therefore, an investment in IREN today looks like a high-risk, high-reward, speculative proposition.
So less of a clear buy or sell and more of a bet.
Essentially, yes, it's a bet on management's ability to navigate all this volatility, execute on their ambitious plans, particularly the AI pivot, and successfully transform the company into a diversified and ultimately profitable digital infrastructure provider in what's clearly a very dynamic and challenging environment.
What a fascinating deep dive. A company truly at the crossroads of technology, energy, and finance. As you mull all this over, we'll leave you with a final thought-provoking question. What aspect of IREN's dual-engine strategy, its foundational Bitcoin mining, or its aggressive pivot into AI, do you personally think holds the most transformative power for its future, and why?
Definitely something to think about. And hey, if you found this deep dive valuable, please like and subscribe to Stock Analytics AI on YouTube.
Yeah, absolutely. And remember, our 4.999-month members get priority requests for deep dives on specific tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
And if you just want a one-off deep dive on a stock you're interested in, you can always drop us a super thanks on YouTube.
One last important note. This deep dive was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
That's right. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.